So there you go. I think there's a snowball's chance in hell that the Federal Reserve will engineer soft lending and that everything will be honky-dory. Wednesday, September 14th, 2022, Maneco 64, home of alternative economics and contrarian views. We're going to look at inflation today. We had the CPI out yesterday. It surprised on the upside. And I'm going to show you why inflation has been baked in the cake since 2008. And you might be thinking, well, Mario, we didn't have inflation up until recently. Well, again, I'm going to say, if you know the true definition of inflation, you will know what I mean. Before I start, though, I like to talk about the Shanghai Cooperation Organization and what is the SCO. Well, according to Wikipedia, it's a Eurasian political, economic, and security organization. In terms of geographic scope and population, it is the world's largest regional organization, covering approximately 60% of the area of Eurasia, 40% of the world population, and more than 30% of global GDP. So it's interesting. The SCO, as it's called, is rarely ever covered in the Western mainstream media. And why is that? Well, because it's basically a very powerful, important institution, in my opinion. It's the heart of the One Belt, One Road, geographically, I would say. So let's keep going a little bit. The SCO is the successor of the Shanghai Five, a mutual security agreement formed in 1996 between China, Kazakhstan, Kyrgyzstan, Russia, and Tajikistan. On June 15th, 2001, the leaders of these nations and Uzbekistan met in Shanghai to announce a new organization with deeper political and economic cooperation. So why am I going on about the SCO, or the Shanghai Cooperation Agreement? Well, they're having their summit starting tomorrow and Friday in a place called Samarkand, Uzbekistan. Actually, it's not the capital of Uzbekistan. The capital of Uzbekistan is Tashkent. But look up that city, Samarkand. It's with a K. It's a beautiful place. But anyway, the reason why I think this could be significant is that President Putin and President Xi Jinping of China are going to actually meet physically for the first time, I think, for over 2 years. I don't think President Xi has been out of China since 2019 or 2020 or something like that. Some people are saying that this could be significant, especially the mainstream media I've looked up. Bloomberg, for example, thinks it could be bad for the Chinese markets, and it could be that the Russians need help from the Chinese with their conflict in Ukraine. But I think it's much bigger than that. It's more about designing this alternative currency bloc, alternative economic, trade, financial, even cultural world, the multipolar world. So I think it would be we could get some interesting statements from the leaders at this summit, and we need to keep a close eye on it. I would say the best way to follow is to Google SCO Summit 2022. India is covering a lot of the mainstream publications in India, because India is going to be there. So yes, let's keep an eye on that. I think that's almost as important for the US dollar than the inflation data that we saw yesterday, or I like to call the price data, the CPI. I think the markets were expecting it to be around 8.1, a drop from 8.5, and that would have given the markets a boost. Markets would have said, well, the Fed has got everything under control. They wish. That's my opinion. Well, it came out at 8.3, which doesn't sound much, but psychologically, that 0.2 can make a huge difference for the markets. We saw the Dow drop just under 4%, S&P about 4.25%, and the Nasdaq index dropped over 5%. And bonds also dropped. Yes, I noticed gold and silver dropped, but they actually did relatively well compared to everything else. And against the British pound and the euro, for example, if they even went up against the pound, I would say gold went up against the pound. But I think the markets and investors, mainstream economists, still think the Fed has credibility. You know, they're giving them the benefit of the doubt. And the reason why gold and silver came off is that they think now the Fed will raise by 1% instead of 3/4. They're going to be tough on inflation. But as I said in the beginning of the video, inflation has been baked in the cake for many years. And as you all know, inflation is the creation of currency and credit out of thin air. The CPI that we see is a consequence of inflation. So if the CPI is very high, it means that the Federal Reserve has been inflating too much. It doesn't mean that we have inflation, it's that we had. But at the same time, unless the Federal Reserve tightens rates, the Fed funds, the short-term target rate, unless they unwind their balance sheet, which they seem to be begrudgingly not lowering that quickly, you're going to continue to get rising prices. All the Fed is going to succeed in doing is creating a major market event. It's going to create a recession, and the cost of living is going to keep rising. It's going to be, in my opinion, worse than the 1970s. And why is that? Well, I've got some charts. I always like to look at charts and history to prove a point. So, and I took this from the Federal Reserve, from Fed, the St. Louis Fed website. And the blue line is the effective Fed funds rate. That's the rate that the Federal Reserve sets. And it came into existence, it looks like, in the 1950s. Prior to 53 or so, there was no Fed funds rate, as you can see. And what is the red line? Well, it's the Consumer Price Index for all urban consumers, all items in U.S. city average. So that's the annual rate of CPI, which is a symptom of inflation, a consequence of inflation. And if you notice here, all throughout from the early 50s up until even, I would say, the early 80s, the blue line was generally higher than the red line. Sometimes it got below that line, so it meant that the Fed funds rate was below the CPI rate, which is inflationary. But there are very few periods that the blue line was below that. And as you can see here, from 1975, that blue line went below the red line. And what does that mean? Well, that means accommodation. The Fed is too loose. The Fed needs to keep their rates above the CPI rate to make sure that you don't get more price rises, to make sure that they're not inflating. And as you can see, from the mid-70s, the Federal Reserve started cutting the Fed funds target because they thought CPI or inflation had topped. And it did top temporarily there. We went from just above 12% down to 5%. But the Fed cut too much because you can see from 77 to 1980, the CPI started moving up again, and it got up to almost 15%. And that's when Paul Volcker realized that they had to really tighten. So he allowed the Fed funds target to get almost to 20%. And the interesting thing about this chart here is that if you look after 2008, which is the gray bar there just before 2010. The red line, which is the CPI, or the consequence of inflation. And I would add, the CPI now is completely different than the CPI in the 1970s. If you use Shadow Stats, John Williams' equivalent CPI to the 1970s, we would be way above 5% in that red line. But where is the blue line? Well, it's been at zero most of that time. Yes, they started raising it in 2016, but it's been at zero, way below that red line for 13 years. It did get above that red line, but then we got in trouble. That was around 2018, 2019, and we had the repo crisis. And now, as you can see, it's massively, I don't think we've seen it as much difference between the Fed funds target and the CPI. And don't forget, the CPI, it should be a lot higher. It's doctored, of course. And I put here the national debt, of course, is getting near 31 trillion. It's 125% of GDP almost. In 1980, the national debt was only 34.6% of GDP. So Paul Volcker, the chairman of the Federal Reserve then, could afford to raise rates way above the CPI rate. Yes, it did cause a double dip recession in the early 80s, but that was necessary. So I'm going to bring up another chart here. Well, there are two charts. And so you can see what's been happening since '08. And I'm going to compare it, of course, to the 60s and early 80s. And you can see that, again, here, the blue line was hardly ever below the red line. It was in the mid 70s and it caused a huge problem. And a lot of times, I have to admit, it was hugging. They were the same, and it didn't help contain inflation. So like in the late 70s, and Volcker had to really let it rip. But look at what we've had since '08. It's just crazy, isn't it? It's the wrong way around. And notice as well that after 1980, that Volcker and even Greenspan kept the Fed funds target comfortably above the CPI rate. And I think that's what gave the Fed credibility going forward. But that credibility, in my opinion, has been shot to smithereens, because now, as you can see, since '08, the red line or the CPI or inflation has been way above the Fed funds target. It was only a small period of time there in the late teens, 2019 or thereabouts, that they were able to get it back above the CPI, but they had to quickly reverse it. And what I think the Fed is hoping now is that people still believe that they're credible, mainly on the back of Volcker, Greenspan, and not Bernanke, of course. But yeah, the Fed is hoping that CPI drops far enough, maybe to 4%. And by then, of course, there will be a huge market economic event, and they'll be cutting again. They think they can cut again towards zero, and everything will be okay, like since the '08 crisis. But I don't think so. I think things are going to get very interesting. And before we look at the markets, just going to show you a clip of the arrogance of these Fed chairmen, especially since Bernanke, that they can just go like this and stop inflation. And they don't realize that inflation really, in the end of the day, at least consumer price rises. A lot of it is psychological. When people start losing faith and confidence in the rectitude of their monetary and governmental institutions, they think, especially people who realize what's going on. Well, I don't want to hold this currency. I'm going to get rid of it. So I'm going to play this clip just to show you the arrogance of Ben Bernanke.
We've been very, very clear that we will not allow inflation to rise above 2% or less.
Can you act quickly enough to prevent inflation from getting out of control?
We could raise interest rates in 15 minutes if we have to.
So there you go. I think there's a snowball's chance in hell that the Federal Reserve will engineer soft lending and that everything will be honky-dory. So with that, let's quickly look at where the markets are this morning. It's 12 past 8 a.m. London time. We got spot gold at 1701.50. It's down less than $1. Range has been 1705. Low has been 1697. Silver is actually up 7 cents at 1940. High's been 48. Low has been 22. The Dow futures is up 100 points. NASDAQ 100 futures up 50. S&P 500 is up 16 points. FTSE 100 index is down 55. The Euro Stoxx 50 is down 11. To the currencies, sterling is up 0.1 at 115.02. The euro is up slightly, just below par at 99.77. The dollar is down 0.75% versus the yen, 143.45. Dollars unchanged versus the Swiss franc, 96.12. Dollars down slightly versus the yuan at 6.97. The dollar is actually below 60 now versus the ruble, 59.83. So the ruble remains very steady, or the dollar and the ruble remain quite fixed here around 60. To the other currencies, we've got Aussie dollar down 1/4 at 67.15. We got the dollar up slightly versus the Canadian dollar, 131.80. And the Kiwi dollar is down 0.1 at 59.89. To the general commodities, WTI crude is down 1% at 86.05. Brent is down 1% at 91.77. High-grade copper is down 0.5% at 353.70. Nat gas is up 1.3% at 840. And let's quickly look at the TTF gas futures, the Dutch TTF gas futures. That's down slightly, just below 200. And to finish off, let's quickly look at the bond markets. Let's first look at the UK gilt market. The 2-year yield is up just over 1 basis points at 312, and the 10-year is approaching 320. It's at 318. The U.S. 2-year yield is unchanged at 376. The 10-year is unchanged as well at 343. So in terms of level here, I think the recent high has been around 350, and if we break through 350, that could be very serious. And some people think that that's negative for gold and silver, rising yields or falling bond prices. But if you look in the 70s, bonds did very badly and gold and silver did very well, and mainly because in the 70s the Federal Reserve, up until, of course, Volcker realized he had to do something. Well, the Fed was always behind the curve, and it wasn't that far behind because, as we saw, the Fed funds rate tracked pretty much CPI. But now, the Fed funds target is not where it should be. It hasn't been for almost 15 years, well, 14 years in 2008. And to think that the Fed is with it, I think people will realize eventually, or markets will realize that they're not. And that's when the Fed will lose complete credibility, I think. Right now, I guess markets still are giving them the benefit of the doubt. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. And think about subscribing to my channel if you haven't yet. And with that, I wish you all a great rest of the day. Take care. Bye.